Hi everyone, I'm James. In my last video, I introduced the idea of focus investing, a long-term approach to investing built around owning a small number of high-quality business and ignoring short-term market noise. But does this approach actually work? In this video, we'll look at some of the most successful investors who have used focus investing to achieve outstanding long-term returns. By studying their portfolios and investment philosophy, we can see that focus investing is not just a concept. It is an approach that has been tested and proven in the real world. Part of my role as an academic is conducting research and writing research papers. In academic research, originality is important. Researchers are expected to develop new ideas, contribute new knowledge, and explain how their work adds to the existing literature. Investing, however, is quite different. When it comes to investing, the ultimate goal is much simpler: to achieve good long-term returns while managing risk appropriately. The good news is that we do not have to start from scratch. Over the years, many great investors have tested different approaches and demonstrated what works in the real world. As investors, we can learn from their successes, study their decisions, and apply the lessons they have discovered through decades of experience. In the following slides, I will introduce some of the most successful investors who have used a focused investing approach and achieved market-beating returns. By studying their investment philosophy and results, we can gain a better understanding of how this approach works in practice. It is difficult to discuss the power of focused investing without starting with Warren Buffett. Over his 6 decades leading Berkshire Hathaway, Buffett generated an average annual return of 19.8%, compared with 10.4% for the S&P 500 over the same period. Those returns may not sound dramatically different at first, but over nearly 6 decades, the power of compounding becomes extraordinary. A $10,000 invested in S&P 500 would have grown to almost $4 million. The same $10,000 invested in Berkshire Hathaway would have grown to roughly $500 million. There are many ways to explain Buffett's success, but one factor stands out. He consistently concentrated capital in a relatively small number of high-quality businesses and held them for very long periods of time. To illustrate this point, I've shown Berkshire Hathaway's 5 largest public stock holdings over the last 30 years. One thing that stands out is that this top holding accounted for around 60 to 70% of the portfolio. In other words, a significant portion of their capital was invested in just a handful of companies. Another observation is the holding period. Many of the company's investments were held for 10, 20, or even 30 years. This combination of concentration and patience allows great businesses to compound their value over time. Of course, long-term investing doesn't mean never changing your mind. Buffett has shown that he is willing to exit investment when circumstances change and make high new conviction investment when opportunity arises. For example, Berkshire held Wells Fargo for more than 30 years before fully exiting due to ongoing operational and governance issues, while at the same time increasing its investment in Bank of America, which later became one of his largest holdings. Perhaps the most famous example is Apple. After largely avoiding technology stocks for many years, Berkshire invested more than $30 billion in Apple between 2016 to 2018. Apple quickly became the company's largest stock holding and turned out to be one of the most successful investments in the company history. By the way, much of the historical information on this slide comes from a book that I recently read, The Complete Financial History of Berkshire Hathaway by Adam Mead. If you're interested in learning more about the company's remarkable history, I highly recommend it. Now you might argue that Warren Buffett is once-in-a-generation investor, and that using him as an example sets an unrealistic standard for everyone. That's a fair point. But in the next few slides, let's look at several current professional investors who also use a focused investing approach to achieve outstanding long-term returns. Let's look at Bill Ackman and Pershing Square Capital Management. One aspect of Ackman's investment style that I found particularly interesting is that he combines concentration with a willingness to change his mind when the facts change. Like many focused investors, Ackman runs a highly concentrated portfolio. As of the first quarter of 2026, Pershing Square held only 11 stocks, with the vast majority of its capital invested in just 7 positions. However, concentration doesn't mean holding on every single investment forever. In 2022, Ackman invested heavily in Netflix after its share price declined significantly. But shortly afterwards, new information emerged that challenged his original investment thesis. Rather than hoping things will improve, he sold the position and openly acknowledged that he had made a mistake. More recently, the company invested in Google when Ackman believed the market was undervaluing the business. As the valuation became less attractive, he shifted capital towards Microsoft, which he believed offered a better opportunity at the time. I think this highlights an important point about focused investing. The goal is not to hold a concentrated portfolio at all costs. Instead, the goal is to concentrate capital in your best ideas. When a thesis breaks down, or when a better opportunity emerges, a focused investor should be willing to reallocate capital accordingly. The next example is Chris Horn. He's a British investor and founder of TCI Fund Management. Over the past 2 decades, TCI has generated around 18% annual returns while growing into a fund managing roughly $45 billion. What makes TCI especially interesting from a focused investing perspective is its extreme concentration. Despite its large size, the funds only hold 9 positions, with more than 85% of the portfolio concentrated in just 6 companies. This reflects Chris Horn's investment approach, which focuses on high-quality business with sustainable competitive advantages, strong pricing power, and long-term structural growth, where capital can compound over time with limited need for intervention. The largest of these positions is GEL Place, which represents close to 1/3 of the portfolio. It fits this quality framework really well, as the jet engine industry has high barriers to entry, long product cycles, and decades of recurrent service revenue once an airline commits to its platform. In many ways, it shares characteristics with companies like Visa and credit agencies like Moody and S&P Global, with dominant positions and high switching costs that support long-term earnings power. Beyond investing, Horn is also well known for his philanthropy. TCI actually stands for the Children's Investment Fund, and through the foundation, he has donated billions of dollars to improve child welfare globally. My final example is Li Lu. He's a Chinese-born investor and founder of Himalaya Capital Management. After moving to the United States, he studied at Columbia University, where he developed a deep interest in value investing inspired by Warren Buffett. During his time, he met Charlie Munger, who became a key mentor and long-term supporter. Munger not only backed him with his own money, but also described him as one of the few external fund managers he deeply trusted. This relationship with Munger is central to Li Lu's investment philosophy, which closely reflects a Buffett-Munger style focused on high-quality businesses, sustainable competitive advantage, and long-term compounding with very low turnover. A defining moment in his career was his early investment in BYD, made during the company's early development phase before it became a global leader in electric vehicles and batteries. that position grew into a multi-bagger over time and is regarded as a landmark example of its ability to identify major structural winners. Humanian Capital currently manages around $3 billion and has generated approximately 20% annual return over the past 2 decades, with a very highly concentrated portfolio of only 14 holdings. The portfolio is heavily concentrated in a small number of positions. Right now, Google is the largest, representing over 40% of allocated capital. This reflects both a large initial investment and the decision to maintain the position even after a significant share price appreciation in the past year, consistent with a low turnover, conviction-driven approach. So, what can we learn from these investors? Across Buffett, Edmund, Chris Horn, and Li Lu, one pattern stands out clearly. Concentration can work at any portfolio size. While it might seem risky to allocate capital to a small number of companies, these investors, each managing billions of dollars, demonstrate that meaningful outperformance does not require owning lots of different stocks. A second takeaway is that concentrated portfolios can outperform over the long term, but only when supported by exceptional business qualities. They consistently focus on companies with sustainable competitive advantage, whether in the form of technology platforms, infrastructure, and financial monopolies, or long-life industrial assets. However, concentration alone is not enough. Success requires deep research and patience, the willingness to hold through volatility, and allowing compounding to play out over years, not months. Importantly, there's no single winning stock style. Each investor operates in different geographies with very different holdings and entry points, yet all achieve strong results by staying disciplined within their own framework. Ultimately, conviction is what turns ideas into meaningful outcomes. It allows capital to be allocated decisively when opportunity arises, rather than diluted across low-impact positions. Research, patience, and conviction are what connects all of these approaches and what drive long-term investment success. I hope you found this useful. Feel free to leave your comments below. Stay focused, everyone. I'll see you next time.